I always speak to a lot of people. They ask me questions about university.
The reason I did uni, and I think the only reason it was valuable, it allowed me to get visas to work overseas. It's an interesting signal, right? So if your Series A investors don't invest in the Series B, people are going to ask why. That doesn't make sense.
Was it a good exit?
Not necessarily for the founders or employees.
I always speak to a lot of people. They ask me questions about university. Is it worth going to university, right? Things have changed, obviously, over the years. Probably back then, back in the day, it was probably had more collateral, more weight than it does now. What's your take on that at the moment in the current market?
Yeah, so it's become more relevant to me because I have children, about to embark on that journey. So the reason I did uni, and I think the only reason it was valuable, it allowed me to get visas to work overseas. So because I had a master's degree, was a shoe-in to get my US work E3 visa. No problem at all, no questions asked almost. Same with Hong Kong. You have to have some sort of piece of paper to show administratively you can do the job you're there for.
So you kind of knew you wanted to go overseas, like really early age.
But also I think there was this, you get a bachelor degree, then you get an MBA. That was sort of the path.
Yeah. Okay.
Now, I went to Macquarie University, which is, a fine school in the Australian context, but getting to spend some time, I did one of the summer executive programs at Stanford at Palo Alto, and that's just night and day. Like the quality of the experience is next level overseas. And it's obviously, 50 times more expensive.
In the heart of VC territory.
In the heart of VCs. I mean, that is why Silicon Valley is Silicon Valley, because of Stanford University being there.
Yeah.
That's where the initial government contracts went. All the spin-outs came out of there in the 30s, 40s, 50s. So,
got it.
Yeah.
Got it. So, so would you advise kids to go to uni now? Or does it depend on the aspiration?
Yeah, so the horrifying statistic I heard the other day from a professor at University of Austin said that kids, 20 years ago were spending 30, 40 hours a week on schoolwork and at uni at UT Austin, and now they're spending 12 and doing the same because they're getting what was taking, days to do an assignment or whatever is now being ChatGPT'd.
Yeah,
and that's the thing. And it's rampant, and there's tools like Turnitin and so forth. They can't really tell the difference between a student writing it and ChatGPT writing it. Like they say they tell the kids at my kids' schools as well. But it's so rampant. And to be honest, I could remember being, at midnight trying to finish an assignment. If that was available to me, of course I would have done it. Right?
So how do you think this is? Can we hover on this for a little bit? This is super interesting.
It is.
So how do you think technologies like chat are going to go in and back in education?
So from my experience, right, it's made me superpowered because I have the experience, and I can write an email if I need to, or do research if I need to. But because I have these tools available to me, like Perplexity and Gemini and ChatGPT, I can use them really effectively. Yeah. But I had the critical thinking of 50 years beforehand of actually using my brain. Right, when the kids are doing it, they're using ChatGPT from day one. Yeah. So in their formative years, they're not actually learning to go to the library or do research, all those sort of things that make it critical. So it all just comes to them naturally. Yeah. So I'm a bit worried about that. One of the things that schools are recommending is they literally have, and this is UT Austin again, these days where they have no technology at all, and they have to sit in the classroom and write stuff.
It's funny, isn't it? I was watching teaching my daughter to prompt a couple of things, and what I realized is that because of the lack of depth and experience and maturity, they actually don't know how to do it very well. Yeah. Because they don't understand the definition of certain things and certain meanings and certain sentences, right? So it probably takes them a little bit longer to figure out how to use those tools really effectively as opposed to someone who's got a lot of experience, right?
It does. So it comes back to, is university worthwhile? I think for a placeholder for 4 years as you mature, especially boys, right? Like going from 18 to 22, it's pretty valuable not to have them in the workforce, if as much as possible. But, what are they learning there? Are they skills that are going to be valuable for employers when they graduate, right? That's really the critical things. That's why I think trades, construction stuff is so important, because it's going to be a long time before those jobs are taken by robots and AI. Yeah. The entry-level marketing jobs, paralegal jobs, all these jobs which require processing, reading and stuff, and synthesizing information which you'd get an analyst to do, and that'd be the first 5 years of your career, that's gone.
Do you think there's still a lens on, hey, you went to this university, and employees see that as, oh, okay, well, that's probably someone who can commit to something, so let's give them a shot. Do you think that really has any validity these days?
So there's two things. If the employee went to the same university as you, there's that network effect, which is good. And it holds more in US universities, I think. So people take their alma mater seriously, and that's why March Madness is so big compared to the regular season. But yes, it shows discipline. It shows I can apply myself and complete something. Or does it show that I'm super good at prompting and you know, what does it actually show these days? I think for a young person, I would get make sure you're getting as much work experience as possible as well while you're doing it, like getting exposure to the real world. So you come out from uni after 4 years with, yes, I've got the degree, I've done the assignments, I have some basic skills hopefully, but you know, I've spent my summers actually working, learning stuff, building projects, starting a company, all those sorts of things. You can't get ChatGPT to start a company for you. You've got to do that yourself. So there's these.
Well, that's unfortunate.
Well, yeah. Well, eventually you probably will, but
yeah. Well, let's not make this a chat about AI specifically. So, but my last question on that topic is: do you think it's going to go from a 3 or 4 year degree to a 1 year degree?
So
there is talk about this, right? Especially in the States.
It will, maybe for the formal part, but it's actually a lifetime degree now. So there's no reason to ever stop doing courses and learning. And that's a critical thing, right? So you might have a formal education for 15 to 20 years of your life. But personally, I am doing courses, I'm learning stuff like every week.
Yeah.
That's a key thing. That's how you remain relevant. So my key metric, I ask everyone who I work with, do you know more on Friday than you did on Monday? About your business, about the industry, about the competitors, about technology, about everything. As long as you keep that constantly learning mindset, then you'll be fine. So whether your degree is 1 year or 4 years, I don't think it's really going to make a difference. It's going to be expired anyway. Like uni's not keeping up with the technology. So if you're doing a computer science degree, imagine if you did a computer science degree and graduated in 1997. How much of that is relevant now, right? You would have had to keep continuously learning
100%.
about the new softwares, the new infrastructure, all that kind of stuff.
Yeah, good point. Okay, let's pivot back. So you're in a startup.
Yes.
You're overseas.
Yes.
There's only a few people in the business. Did you say you're in Hong Kong or Singapore?
Hong Kong.
You're in Hong Kong on your own.
Yeah.
And then you grow this company to 450 people.
Yeah.
So what was the company? What was the product? Talk to us about that.
So it's interesting. So, I think a lot of it is being in the right place at the right time. So this company originally started, so this is actually pre-Twitter and how did you...
That's X for the kids.
Oh, yes, sorry. Pre-Blue Sky. On PC, mobile, and these new devices which are just coming out, like the Roku, Apple TV, Samsung Smart TV, that kind of stuff.
Yeah.
Right. So it was like a tough, I won't say that it happened instantly. It was a tough sort of 18 months. The first, there was just me, a couple of people. I remember the day we hired our first intern was the day my wife went into labor in Hong Kong. So this poor kid, he just came in the morning and said, "Oh, welcome to the workforce. I'm out." And I got a call from my wife and had to run up to the hospital there in Hong Kong. And that's when my son was born.
Yeah, right.
So I remember that very well. And the CEO actually asked me back. So the company had its 20-year anniversary the other day. And the CEO asked me and a couple of people, and we did a live event and podcast just talking about the early days.
Yeah, cool. Well, that's cool. So commercial streaming services, right? That was such a big play in the market. Globally, a lot of people got on board with that. So how do you go from a startup? I'm assuming you raised capital, right?
Yeah,
there's maybe one or two.
We raised a little bit of capital.
Yeah,
but a lot of the work we're doing was actually like project work. So work for hire. So an example, like Netflix would come to us and say, "Hey, we have a big internal development team, but the new Xbox is coming out and we need to have our app ready for it."
Yeah.
And so they would come to us and we would build it for them.
Yeah, right.
Yeah.
Interesting.
Or so we work for Disney.
So was it bootstrapped to a point, or
it was
or the
bootstrapped
majority?
by the founder, these two founders, Michael and Frederick Bootstrap. Then we got an investment from because they're a Swedish company, some Swedish investors.
Can I ask how much that was?
You can, but I just don't think I remember, to be honest. It was sub 1 to 2 million euros.
Okay.
Yeah.
Yep.
So not
So quite a small.
not huge. So,
See.
but most of the growth was actually, we'd get a deal with HBO, we get a deal with Fox or Disney, and we need to keep staffing up.
Yeah.
And the reason why we ended up with so many people was, so we had the office in Hong Kong, and that grew to about 100 people just in that office, which is a very interesting challenge from a real estate perspective, let alone anything else, because that is the most expensive.
There was no work from home at that time, kids. If you you had to go to the office, remember that?
And when your home is 450 square feet and there's 6 people that live there, you don't want to work from home. There's no such thing. So it's actually the challenge is getting them to go home. Yeah, that's really the thing. Like it's not even on the menu working from home in Asia and a lot of these places, because that doesn't
that's
make
interesting.
sense.
Yeah,
it is. Yeah. So if you have a home that's comfortable and nice and you want to stay there, that's cool. But when grandma and mom and your brothers are there and what are you going to do? You can't work. So that wasn't a problem, but it was just a matter of dealing with those people. But as I was saying, the growth was really okay. So we probably maxed out the talent in a certain city, so we couldn't really get any more developers in Hong Kong. So we'd go look, and then we opened an office in Sydney just to support Telstra. We were opening offices in Eastern Europe as well, just to expand to support European customers. And then the CEO came and said, well, look, let's try and make America work. So I was back where I started, flew to Palo Alto, and it was just me again at the Plug and Play Tech Center in Sunnyvale.
And that was off the basis of we need to find more talent. So we think it's there.
Well, more talent and closer to the customers. So our customers. So we ended up. So firstly, opened an office in that's Silicon Valley. That we're in Palo Alto. Moved around a bit. Opened an office in LA. Opened an office in New York, because we're dealing with these media companies. So New York is about TV typically. Hollywood, Los Angeles is about the movies.
Film.
And so we had people there supporting these projects for all the streaming companies as they were just coming along. So it was really, and just because we had a reputation as being early and we had good relationships with all the manufacturers like Samsung and LG and Apple and Xbox, these guys are approved, these guys can get you done with your deadline. So that's how we grew the business, really. Fantastic.
So can I ask, at what stage of the business, so you're moving to San Francisco, to California. At what stage is the business at in terms of size? Because you mentioned
we're probably at
you
that
got to
point
450, right?
Probably a couple of hundred at that point.
Okay, so you're about halfway through.
Yep.
Okay.
And then we kept growing, and so we took an investment from SEB, which is a big Swedish private equity firm, part of SEB Bank. And they gave us the capital to really expand, and ultimately, ended up acquiring most of the business, but keeping the founders in place.
So you mentioned, I want to hover on something for a little bit, go back a little bit. So you mentioned, what I call talent burnout, right? I think you just get to a point where, I think the most important thing in a company is talent, right? And it can succeed with great talent. It will probably fail without it, right? So they made a decision that, okay, we've burned out this market. You've attracted everyone you can. We're going to pivot and we're going to go to another country and we're going to try our luck at that. I know there's probably account management and business to be done there as well, and offices are set up. I get that. I just want to, I think businesses, so we have a lot of startups watch this business, right?
Yep.
And I always, and I say to startup founders, your first 1 to 2 hires will be the most important thing to your company. Can you give me your lens on that? Do you agree with that? How do you think that founders should approach that?
Yeah, so your first 1 to 2 hires are important for that phase of the business, because I think, and I've always said, you can't grow a company without growing the people. So they've got to be able to keep up with what you're doing. So you're a founder and you hire a really good CTO, really good solution architect, really good salesperson, and they're fantastic for getting you from $0 to $1 million. They can go out and beat the bushes and outcome the customers and really work in that environment. As you go from 1 million to 5 million, things start getting more systemic. It's more rules based. The CRM becomes more important. There's actually 3 salespeople, not 1. So things really start to formalize, and even founders, right? So certain founders can keep going through the whole cycle. Certain founders either get tapped on the shoulder by their investors, or they go to a different role other than CEO or founder, right? They just I just want to do product. This is what I'm good at.
From your experience, do you think the founder should be the CEO?
No, not all the time. No, of course not. And it really depends on the situation. So plenty of examples where founders have been either pushed aside or they just prefer to be like a product person. So if you're a hardcore product person, that's what you want to do. You don't want to be doing board updates, dealing with HR issues, like updating the market, funding. You like talking to customers to find out what's going on. But like all I want to do is build products and make the best products I can. I want a professional CEO to come in and manage. And this is from the Silicon Valley playbook all the time. So there's a whole cast of professional CEOs who'll come off and come into the business and say, okay, we're at 25 million. We need to get to 50 million. We've raised $20 million capital. Come in and professionalize the business. So put the systems in place, get the HR happening, get the SDR onboarding and the sales funnel working properly because that's what they're good at. And, we can handle sweet talk the investors, go and schmooze with the customers and the founding team, the founders, whatever, if that's their bent, can just focus on what they do best. And some people are relieved. Others, like, the hardcore Zuckerbergs and so forth, will stay the journey. But look at Steve Jobs, right? He got kicked out, came back eventually. There's different archetypes, but there's no one answer. But you might be the best CEO in the world of a $10 million business, but you can't be the CEO of a publicly traded company. Like if you went public on the NASDAQ, it's such a different skill set than being CEO of a 10 or 20 or even $50 million business.
So maybe for young founders who are watching this, get a co-founder, right, who's got an alternative skill set to you or talent.
Well, you should definitely have complementary skill sets. No use having like 3 salespeople as founders. Like the technical co-founder is becoming not less important, but there are tools now to really speed that process up where you really needed someone a few years ago to do it. But you should have like complementary people. So you should have like, whatever the industry is, like someone deep in that from a product perspective, but then someone who can actually raise money. Raising money is its own skill set. And they don't teach you that. There's no such, I've seen courses on fundraising and so forth, but it is something that can only be learned by doing it and experiencing the unpleasantness of it all.
So I still want to break this down a little bit. So the guy who raises money, that's probably more of a CEO orientated type of personality, right?
The investors in the early stage want to hear from the CEO. Whoever that is. Because if you're just raising the first $500,000, $1 million, then that person is selling the vision, telling the story, explaining the product from their own use case because they're solving their own problem typically. That's what gets them excited. And they're thinking, okay, well, this guy's good or we might replace him in 5 years, doesn't matter. But I can see at the moment, this is the perfect scenario.
And the tech personality, he's the product market fit guy, he's a UI UX guy, he does all of that, right?
Could be, but there's people who are a combination of everything, rare breeds who will go and pitch the hell out of something at a pitch night. But I think the most compelling pitches don't come down to showmanship. It's just like I've seen technical pitches, but just because they are so deep in the product that they make the story compelling just by telling it what they do, explaining what it is, how they do it, why they're solving this problem. There's no need for anything extra other than that pure story, essentially.
I see these young founders who have a pretty good product, actually, especially in that SaaS space, but they don't have anyone who can sell it, right? So is your advice that, you should have a sales-oriented marketing type co-founder or first hire in the business?
Well, there's no point to your business if you don't have someone to sell it, or there's just not natural demand for it. Like, companies have scaled with no formal sales. Right? I know many examples, but they've just gone out, technical people, talking to other technical people, hey, I can solve this problem. They get deals and things just happen. And then after like 5 years, they go, actually, you know what? We need to actually have a channel strategy and have salespeople in here to manage all this.
There seems to be this, in the conversations that I hear and a lot of the media, there seems to be this this communication track about if you're not a SaaS company or a software company, don't bother about, fundraising. Just forget about it. Like, is that, what are your thoughts on that?
Yeah, so think why that is fundamentally attractive. Why is software the greatest business from an investment perspective in history, right?
Right.
Well, so the next product I sell costs me zero. You have incredible margins, so I can build a cost base of X and go increase sales exponentially without having to increase my cost base.
So build it once and sell it 1,000,000 times.
That's it, right? So that's why what was the biggest industry in the world in the 1970s?
Was it manufacturing, steel?
The music industry.
Oh,
because
the music industry.
Yeah, that's why Led Zeppelin had like their own jet when they were touring around, because that was like an unbelievable software business, like records, selling them for whatever they were, $12. Couldn't copy them back then either. So like, and it's still the best business in the world. So if I'm investing in real estate, I'm hoping for maybe 6 or 8% yield.
Yeah.
Maybe a 15% ARR over 5-6 years.
Yeah.
If I'm investing in your software company, I'm hoping to get like a 10, 20, 50x return, right? I'm expecting crazy returns because of this exponential.
Or you're going to lose your whole investment. One of the two things.
Well, more often than not, you will lose your investment because it's harder than it looks. But so in terms of every investment model out there besides some kind of monopoly, that's why software is what Silicon Valley and these guys love.
Yeah. So if we go back to the business, so you're around 250, you're sort of in the middle of the business. You've gone to LA, California, and these two guys were smart enough to know this is all about talent. We need more talent. Did that work? It did. Yeah.
So why? Well,
you're in the Bay Area. I guess that's where it was starting to harm a little bit.
So and that's pluses and minuses, right? So in the Bay Area, I'm competing with Google and Facebook,
and you got to pay them more money,
and X and Intel and Cisco and everyone else who are there, and we're just this unknown Swedish startup. Yeah. So we had to get aggressive, but I don't know if it was luck or my particular skill at recruiting. I think it's probably luck that we ended up with really good people. Who we could build. And sometimes, and that involved, it was more like a Moneyball approach, right? So I couldn't get the $500,000 a year Google engineer, but I could get someone with, a couple of years experience, comes from a good uni, who maybe needs visa. So we're very, helpful with people for their H-1Bs, which is a super powerful attraction and retention tool.
So going into that, what's your strategy? Like if you've got all this competition, right? You're in the Bay Area, there's all these great companies that people probably move there to go and work for.
Absolutely, they do, yeah.
They probably pay them more than what you can.
Yeah, they do.
What's your strategy? How do you beat that?
Yeah, so it's like I said, like, so what's the Moneyball strategy? You get like the best possible complementary people, because like if Google has like over 300,000 or 500,000 applicants per year to work there, or maybe more, right? So it's fantastic. So they'll take 1% of that, or a very small percentage.
So is that like through a job board? Like, do you have to go to networking events?
Just inbound, So getting if Google, put an ad up, they'll get thousands and thousands and thousands of responses. So they have a pretty elite approach, and they'll, you see what Zuckerberg's doing with AI stuff now. Yeah, it's crazy. But so not everyone can work there, but it doesn't mean that everyone else they reject is not worth having, right? So there is a deep talent pool, but what we did find was, we could potentially recruit people, but if we had someone who was working with Netflix or working with HBO really closely, they would go, hey, and they'd try and steal our people. And that's hard. Like, so if Netflix offers you a job and you work with it, and especially Netflix then, and their peak, their share price and their unlimited leave and all this sort of stuff. I mean, that is a great company. The culture, getting to see that up close was fantastic, I have to say. Like, getting to see all these companies up close was really cool. But that is the danger. But that's just like part of doing business. So maybe you get 2 or 3 years out of that person and they go to Netflix or they go to Google, and that happened all the time. That's cool. But, we kept growing, expanding. You're always building a pipeline. So never stop recruiting in that scenario, because you're always going to be backfilling. That's why we went to, I think, Los Angeles next, just to be closer to the studios. That's a slightly different market in terms of tech talent. So the skills we're looking for were essentially software developers.
Yeah. So so obviously you guys are sitting there having conversations. Where is the talent? So you're looking for industries and certain locations. Who are they attracting and recruiting and going to those markets? Right. Yeah.
And then you get to a point where, okay, we're in New York, we're in LA, and we're in Palo Alto. We have to start putting some of this stuff back to Asia or back to Eastern Europe. As far as the customer knows locally, hey, we'll come in. We'll have a solution architect team in LA. They'll come and meet you at Sony Studios, meet you at Warner Brothers, have the meeting. But a lot of that work was being sent back to somewhere in Eastern Europe, back to Hong Kong, other places, to work basically 24 hours a day. Then we'd come in the next day, check the code, push a release to the customer. So that was. that was the approach.
So just something you said before about, look, I know Zuck's is, some of those salaries are $100 million. It's pissing a lot of people off, by the way, but hey, he's investing in that talent. So would you advise, like if you're a small startup company and you need to attract talent, is giving away equity or shares or profit share a strategy to attract the right people?
Depends on which market we're talking about, but I think giving you want employees who think like owners. Obviously, like that's super powerful because if they're thinking like it's their own business, then they're going to be respectful of your resources. They're going to try really hard. They're going to do their best because it's like my company too. So I think that having that mindset is great. And there's different ways to structure it. So it's expected in Silicon Valley, hey, what is my, I get my $300,000 and 0.25% or 1%, whatever it is.
Valley, there's a statement.
Yeah, exactly. So here it's less common. I think, we have slightly different tax laws and the way it's treated. Yeah. But anyway, and there's different ways about it, but having, number one, you want to have that ownership mindset. And you can, you can have like that through profit share, there's different ways to get it. But hey, if we're all, what happens to me, it also happens to the company. You don't want people thinking, well, I'm doing a good job and stuff everyone else. You want everyone to think collectively about what they're doing. That's a great way to do it. So, but just structuring is different depending on whichever market you're in. Because in Hong Kong, for example, that wasn't expected at all, wasn't really even a thing. They just want to get their money, and that's fine. And that was fair because it's not as though we had a near-term plan to exit or anything at that point. Yeah, you can't tell someone who's just joining at 22, hey, we might sell this in 10 years or we might not, but here's some shares.
Yeah, interesting. All right, so you're steaming ahead. The company's growing. You're picking up more contracts, recruiting great talent. Where does it go to from there?
It gets to a critical mass. I mean, and this is, you talked about sort of talent burnout before. So I'd been there for 8 years at that point.
Wow.
And that's, I think I'd probably had enough at that. So going from from Hong Kong to the US, expanding, going, being through the transformations, going through those different levels of, people keep going, but also people just say, well, I want to tap out at this point as well. I think there was
So when you say that, is it because you were burnt out? Was it just like hours?
I think I was just, look, I still enjoyed the job. I think I was just bored with it. Like I'd done it. I didn't see there was anything new to do. We're going to do the new version of the Netflix app. Well, we did it last time. And it's like, there's no, the same, we're going to sit down, we're going to do the requirements, we're going to work out the software development plan, we're going to do our payment milestones, we're going to do delivery, and that's it. So I think from a personal growth perspective, I was looking for something else.
You don't grow in that role.
Yeah. And sometimes you got to go out and find it. In my case, I was sitting in my office and this Australian startup walked in.
Really?
Yeah. Who they asked to come and see me for some reason. And it was a really interesting, it was an early AI startup. Yeah. And their investors were like Intel Capital, Warner Brothers Music, Citrix. Wow. And One Ventures here in Sydney.
Can I get two of those?
Well, can you imagine the board meeting? Sorry, but Warner Brothers Music and Intel don't really mix in a board meeting. But anyway, it was a great experience. So they came in and they wanted a CEO to do this. And it was a mobile kind of AI notifications.
So what year are we in now?
2015.
2015.
Yes, I know. See, we're only 20 years into my career. I'm not sure. I hope this is like a 4-hour podcast. Because it gets good soon. The next 10 years are super exciting.
Well, I'm 147 years old. I don't have much time. So it's 2015. Cool.
Yeah.
Okay, carry on. Yeah.
So they came in and I thought, well, this is, super interesting. I've never been like a CEO before of a venture-backed company.
So you're saying there was AI before ChatGPT? I don't believe it.
Yeah, wow. I know. Well, so, the Transformer was invented by Google in, I think, 2017, right? Yeah. And this is 2015. So this technology spun out of NICTA, Data 61, the branch of CSIRO here in Australia. So super interesting mix of technology and I think way ahead of its time.
But did you say two Aussie guys?
I think that the other founders were two Australians. But so they had this little team. There was a bit of a software team in Sydney and so forth. And I spoke to the investors and I said, come on board as the CEO. And I thought, oh, this sounds fun. And since then I've developed a checklist of things to ask if someone asks me to be the CEO. But the best experience is bad experience, as they say.
That's true.
No, but it was a tremendous experience. But just obviously dealing with those different things. And one thing I will say, like if you have a strategic investor, it's fantastic. until their strategy changes.
What do you mean by a strategic investor?
So strategic investors typically, so a VC is like a purely financial investor, right? So they're investing to get a return on capital for their LPs.
Yeah.
A strategic investor, like an Intel or an LG or a Samsung or anyone who invests in your company who's not necessarily in it for the money, they want to exposure to that market. They want a preview of technology. They just want to be in that particular business with you, and that's cool. But if their strategy changes, then it's like we kind of like let loose, and what do we do with you now? And or people change because turnover is very high in these big companies. So it was a really interesting experience from that perspective. I'm sure all the NDAs have expired or whatever by now, but it was. We ended up exiting the business to MVNO company here in Sydney.
Yeah, right.
Yeah, so super cool. So they use their technology basically.
How many years was it till exit?
I think we did it for about 3 years.
Wow.
Yeah.
Was it a good exit? I mean, financially?
Well, I think there's some stock that's still rolled over into various companies, like not necessarily for the founders or employees, but it was just, I think it's one of those things that the technology lives on embedded in other things. So sometimes you have invented a feature, not a product, and not a company.
Yeah, interesting.
And that's one of these things that's a great feature of a broader suite.
Yeah, that's super interesting. Okay, all right. So 3 years. So we're talking 2018, 19.
Yeah.
Did Sam Altman give you a call?
Yeah, no, I wish I was never that high profile in Silicon Valley. But then we have all the nonsense. So going through COVID in California was interesting. There was I from that point was just working with a number of different startups. Like a interesting one, another sort of case of good timing, but this company up in Portland, which was doing kind of video product demonstrations and stuff for retailers, like Nike was actually their biggest customer.
Yeah, right.
And they're going all right, but when COVID came along, they exploded, and they went from like 50 people to 500 people because everything went online. And so imagine like if Nike's introducing a new shoe, they have like 3,000 retail outlets that need training and different channels and so forth. And that was so I did production and video streaming for that. So that was super interesting.
They're quite exciting roles, right? Like I think I haven't heard a role that you've been involved in so far. We're at 2019. That sounds boring.
I mean, I've had a tremendous amount of fun in my career. I mean, that's a big. I mean, you got to love what you're doing. At least I do love it, right? I do love selling. I love technology. I love raising money, even though it's hard. I like the energy of entrepreneurial companies. I haven't for a long time and probably never will work for a large corporation again. I mean, I can't imagine where I'd fit in especially at my age. There's not really roles going, but that doesn't matter because there's so many more sort of early stage things, 100%. Right? And so we get to COVID, and so one of the overriding issues in COVID when everyone's at home was the poor state of the internet. There were stories of like kids having to go to the car park of McDonald's to get on the Wi-Fi to get their and so
get their social fix.
Well, just to do their schooling, right? Because they're doing Zoom schooling. So that's we had a lot of Zoom school and other nonsense like that. But we had that, and I was with some friends in Redwood City. I remember Pete's Coffee in Redwood City, and a guy I've known who'd helped work with me on the other startup where I was CEO said, "Hey, I've been thinking about doing something with the internet." With internet infrastructure, like fixing like the core problem of the internet, which is the physical infrastructure, because the internet is made of plastic.
Fiber is what you're referring to.
Yeah, the internet is made of plastic and glass and steel, and it involves digging up the side of the road and like other sort of messy things like that. Yeah, it is. It is. And I thought this sounds like ambitious, and I've actually never thought about building a network before, and so And it's obviously a big task, and that could be its own podcast, but it is like a technological endeavor. It's a political endeavor. It's an economic endeavor. It's so many things because you're actually building infrastructure. You're dealing with governments. You're dealing with all manner of things, railroads and all kinds of stuff. But anyway, so we hatched a plan. We formed a company to actually build a essentially backbone fiber optic network.
Sorry, so you went on as the CEO. What was your?
No, I was like chief development officer. So my role was like looking at the routes, getting anchor customers, spending most of my time fundraising, actually. So that was really interesting because the people we're pitching to are everyone in in infrastructure like Brookfield and Carlyle and KKR and Apollo and Macquarie Infrastructure and the Australian super funds.
That's a very strategic investor, right? Because you're looking for someone who's got current infrastructure.
It's someone who understands the infrastructure business, who's not afraid of a greenfield. So a lot of these Australian super funds, for example, we talk to them and it's like, we'll come back when it's built so we can have something less risk. Because like development risk is huge because you can put $100 million into something and it doesn't get completed.
Well, you've got council approvals, you've got...
permitting agencies could be like 30, for example, so you have
crazy.
The State Department of Transport, it's called the DOT for the state highways.
Yeah.
Then you might have each city, you know how there's cities and counties in the US which have individual agreements. You might have a railway crossing. You might have a water crossing. So if you have a little creek, you've got to go to the Army Corps of Engineers.
So that's all falling on your plate, really?
Well, we obviously had people who'd come out of DOTs before who were permitting experts and so forth. But getting that story, and it took us a long time even to figure out where to build it because founders are from New Mexico, other founders. So we thought we'd start in New Mexico, but too much of a challenge, too hard. Just again, I told you it's a political thing as much as an economic thing and a technology thing. So there's all these different factors. So then we looked at an East Coast route. We looked at a few states. Yeah. We spent a long time in, let's call it state X, but we didn't end up, spent about a year in the capital of this state working with politicians and people and didn't build anything there.
Wow.
Then we settled on where we did build and are building, which is Virginia. Yeah. So what's special about Virginia? It is the home of the internet. Essentially, it's got more data centers than anywhere in the world. It carries most of the world's traffic. Internet traffic goes through just outside Washington, D.C. in a place called Ashburn, Virginia, and Manassas and places around there. Yeah. So how did that happen? AOL was there and some guy was put one computer next to another one and connected it, and that was AOL. And this ecosystem grew up around AOL. And that's why, vacant land, if you can get it, is $2 million an acre now, and they have all these sort of power problems and so forth. So we thought, well, why not just go to the heart of it all and build something there? And eventually we would love to build across into the whole country, but that's what I was doing through most of the COVID.
I would just build it next to an oil field.
Yeah. Well, that's a great point. So we have spoken to oil
gas fields, right?
Yeah, so oil and gas people, spoken to them. So obviously power is the biggest constraint now 100%. On these data centers, because essentially we're connecting data centers to data centers. Like if I am, downloading an email, so I might be in Washington, D.C., that signal will go probably to a data center campus down in Richmond, or maybe it's one in the center of the country from Google, to my laptop or to my phone. I mean, it's a very physical thing and they're always moving stuff around. But so that's, we're thoughtful about where we're putting the networks. And it's like now, and this is again timing, no one was talking about AI in data centers and stuff when we were doing this, like the AI explosion. Yeah. And this week,
that's sort of good timing though, right?
It is good timing. So you've got to be on the field, and all of a sudden, oh wow, this could be. We might actually need to, allow for more capacity. Because it's just getting started. And if on average, about $5 billion a month is being spent on this kind of infrastructure just in the US. Yeah. Meta just announced almost the largest private credit deal ever, just $29 billion, like $3 billion equity and $26 billion in debt for just US data centers. Yeah. So if you look at it, it's about, they're probably building at $5 million a megawatt. Yeah. So imagine how big those campuses are. There's just gigawatts of power.
It's a new thing, right? Like just power, data, storage, data transportation, man. It's like
GPUs, but it's all useless without the connectivity. So there was even a period of the Bitcoin miners as well, but I think that business is less attractive, and there's swapping out the ASIC miners for GPUs and just converting into AI. That's where I think CoreWeave started as a Bitcoin miner. But pivoted to AI because why not? That makes more sense. I can get the GPUs off NVIDIA and and away you go. So I was doing that business, and
shout out to NVIDIA, 4 trillion market cap.
Congratulations.
Only a day or so ago. That's
amazing. And who knows where it's. I mean, if you're buying at 4 trillion, where do you think it's going to go? Do you think you're going to double your money? I don't know. Or you think it's going to start paying massive dividends? It's super interesting to even think about buying it at that price. But people are doing it.
Yeah, it's crazy. So infrastructure.
Yeah.
Data. So you're in that business.
Yeah.
You landed in Virginia.
Yep.
It's chipping away. Now you're still involved in that company.
Yep. So I moved back. I wanted to, give my children. So my son was born in Hong Kong. My daughter's born in California. We'd been there for 11 years. Yeah. COVID and so forth. We thought let's just come back and I was from Brisbane. We thought we'd come back here and see what was going on. But I did want to remain involved with that company because I'd obviously started and so on. Put a lot of time and effort into it. Yeah. And these things take a long time. So infrastructure is a multi-year project and end to end, by the time it's all finished and exited, it might be 10 years. So, and that's fine. It just ticks along. I mean, it's just one of those things where you can't make any sudden moves because once you've, approved and got a route picked, you can't say, well, actually, let's just
put it over there
60 miles west or
there's a tree in the way. Can we just now put it over there,
or worse, a train line or anything. It's so, but involved in that, and I like it because we're still dealing directly with the biggest consumers in the world of internet infrastructure, which are the hyperscalers, so Google, Meta, Microsoft, AWS, the AI hyperscale companies, the data center companies, CoreWeave and such. People like Starlink now, that's becoming a big. So the Starlink ground stations. Obviously need connectivity. Even though there's satellite, it's all powered by fiber, same as 5G and 6G that's coming. It's
people
all going to be
don't
fiber.
quite understand that. They think it's all up there. It's not.
Exactly. Yeah.
So you mentioned exited, right? So sometimes, and I'm just going to quickly just jump into that a little bit. Is it always the plan to exit? Is that someone starts a company, especially in the tech space, right? The plan always seems to be to exit. Why is that?
So the plan might not be to exit, but if you take someone else's money, whether you like it or not, to a certain extent, you adopt their business model. So if I take venture money, their business model is a 10-year fund where they invest for the first few years. The fund matures, the company matures, and hopefully some of those are successful and they sell the fund and return the capital to the LPs. So sometimes you have no choice. And in the olden days, there was a lot more, at the olden days like 80s and 90s, even 70s, like IPO. There's a lot more IPOs and companies IPO'd a lot earlier. You look
can I just ask, what's the status of an IPO? What do you need? X amount of revenue, blah, blah, blah. What is the requirement?
You certainly need, and it depends on the stock market, but you also sort of think, so a small cap or micro cap in the US is $4 billion market cap now. So if there's several thousand stocks on the stock market, how am I going to get any attention from the analysts? How am I going to have my story heard? So do I want, and companies stay private for a long time, but you really have to have substantial scale if you're thinking about NASDAQ or New York Stock Exchange. In Australia, the number of listed companies is shrinking. I think there's a few hundred less than there were like 10 years ago. It's interesting. It's still an interesting capital market, but there's a lot of pluses and minuses. I mean, if your company was big enough, then why wouldn't you go on NASDAQ? That'd be amazing because you can have that liquidity, you can raise money easily, you have the discipline, and it's fantastic. But you're getting, as a CEO, you're getting a scorecard every day. The share price.
Ooh,
I know, you're getting a performance review.
But look, I guess investors want ROI, right? They want to make their money back. So I think exit is the time that they
but if you kind of bootstrap the company or take minimal capital and you even like buy out the investors and give them a return. If you love the business and want to keep running it, well then you keep doing it. But it's got to be, if it generates cash flow. I mean, the logical thing to do would be to maybe IPO. So you get rid of your early investors, give your employees, maybe you've incentivized them, they maybe had below market salaries, maybe they had a lot of stock or whatever. You've got to pay them out at some point as well. So, but I can certainly understand, would Mark Zuckerberg ever want to leave Facebook? Of course not, right? And Bill Gates was at Microsoft for 40 years or something. They're entwined with the company, so they're not necessarily going to want to leave it. But I think investors will come and go. So maybe you exit your investors.
There was that real fast-moving VC and investor exit style in Silicon Valley, right, with all these young startups, and the valuations on paper probably weren't worth a lot. The market was heavily overinflated, and they all thought they were going to go to billion-dollar exits, but that didn't sort of happen, right? When COVID comes, and then a whole bunch of those businesses sort of just fell over. Where's Silicon Valley at the moment, do you think, in your lens?
Yeah, it's interesting. So I think there's a lot of what they call zombie unicorns, right? So there's companies that were at those large valuations who didn't grow into it in terms of their revenue and their profitability. So they perhaps aren't really worth that now. But because they don't have to mark to market every day, they might be sitting on the VC's books at $1 billion still when it's only actually worth, 100 million. Who knows? So I think there's a lot of that needs to be flushed out. But I think it's still the deepest and biggest capital market in the world for startups. So, but they do tend to have a real herd mentality. So, if you're not AI right now, then you're not going to get funded probably. It's interesting.
It is interesting.
I think for an Australian startup, it is super challenging just to go there and get funded. I mean, but it's where you want to get funded, I think. But without having a substantial US business and people on the ground, it's probably hard to do.
So for if we take an Australian AI business, right, and we'll talk about Visera shortly, but so what would be the navigation or the pathway for an Australian AI business? Is it to move fast and break things? Or, what would be the strategy right now? There seems to be a lot of attention on it in Australia as well, I think, as well as the US and China and et cetera, et cetera. So what would be your advice be for a couple of young guys in Australia who I'm tracking a couple of these young guys who are starting to get traction. And they're going into their first seed round. And they've only been operating for 12 months. It's crazy, right? And investors are already looking at them and considering investment. So it sort of freaks me out a little bit. What's your take on the AI market, the investor market right now?
So I think the most attractive thing about any company is its growth, right? So if these guys started a year ago, and they actually have customers, and they're doubling in size every month, for example, right? That's how you get that valuation premium is on your growth. So if you're growing at 50 or 100% a year, and there's the people that know this much better than I. There's certain metrics like in year one you should be growing at like 100%, maybe year two 50%, year three it tapers off, but the growth is out of control because the market is pulling it out of your hands, right? They say, this actually solves my problem. I love it. And you look at the most adopted, tech products in history, like ChatGPT, which has, I think, 100 million monthly active users at $20, $30 or whatever it is. That's amazing. So so the adoption is strong.
Did you see what the valuation for the business was for
ChatGPT?
For OpenAI.
What is it, like 100 billion or something?
No, it was way more than that. I think it was about 650 billion.
Yeah, $500 billion too, actually.
It's crazy, right?
Like $500 billion. Yeah. I know. So that's just goes to show the growth premium. And you have like the big guys like Masason, SoftBank coming in, and the sovereign wealth funds from the Middle East, like PIF and those guys. But
when I hear that name, I always think of WeWork, right? I think, wow, God, that was a big mistake.
Well, I mean, it's reinvented itself. And Adam Newman's done very well. So
he did very well out of it.
But look, so if you've got that traction, because and this comes back to like who are you putting in your team? Like if the product is not naturally flying off the shelves, like organically or virally, and someone's got to push it, well, that's fine, but you have to show adoption, and depends on the segment, right? So enterprise SaaS, enterprise software, no matter what, it's a slog because you've got the corporate buyers are conservative, they'll do a trial, they'll kill you by piloting, right? Death by pilot is a common thing because, hey, company X loves it, they've got 10,000 employees, they'll potentially use it. Let's do this endless trial, and you're talking to the innovation team. Innovation team has a little budget, don't really have any authority to buy anything, and no one listens to them in the business. But hey, we've got this pilot. So VCs are very good at differentiating what is actual genuine customer demand and what is piloting and things that aren't necessarily going to lead to long-term revenue. But that's the number one thing. It doesn't really matter if you're making money or not at that point, obviously, because profitability stopped being a criteria a long time ago.
Crazy, right?
Yeah. Well, until you get public, then I think people be more interested. But it's like, are you growing?
Yeah.
Are you growing? And hopefully it's because, there's such demand, and the problem you are solving is, there's nice to have and there's hair on fire. In enterprise I'm talking about. So hopefully it's a hair on fire problem.
Yeah. So how does a business, and I see these businesses get, whether it's VC or private, get funding off the back of an idea, right? Mm-hmm. Like they have no proven customers. Product market fit hasn't even been established, but there's excitement around the business, right? Mm-hmm. Like, how does that come to play?
A lot of that has to do with founder pedigree.
Yeah.
So if the founder is like a former founder, or comes from an elite university, or has something special about the founder, because that's the only thing to invest in. And even if you have some revenue or customers, what they're investing is at the seed and Series A is the founder and founding team and their ability.
Is that always the case in most situations though as well? Yeah.
Yeah, I think so, because if you're an experienced investor, that the company they're pitching you at the seed round won't be the company that gets to Series B, because they'll learn, they'll pivot, the market will change. But if the founders have either done it before, big tick, because it's like, I'm de-risking, or like they're so compelling, the idea is so good, and they live and breathe it. And so there's examples of both. But I think if I'm going to get like $100 million valuation as an AI company or something like some of these people, it's because I'm an elite AI researcher. I'm coming out of OpenAI. I'm coming out of somewhere.
Yeah, pedigree, that's what you're referring to.
It is, yeah.
100%. So between Australia and say Silicon Valley, right? VC or private, like what is the type of investor you see hitting the AI market right now? Because personally, I think a private or an angel investor is, for me, as we go through, my first fundraise, it's probably the right investor. But just sort of talk to us about the differences and what
so I think there's three sources of capital for an early stage company. So institutional, which is professional investors like venture capitalists, private equity, super funds, those guys who manage other people's money for a living. So they have their own business model and it's pretty well established. Second is strategics. So someone in or adjacent to your industry. Who likes what you're doing, wants some exposure to it. Maybe it's something they want to buy later. Maybe they want to bring it in-house, but they just want to be in that business and they see you as a quick way to do it. And the third is like the private or individual investors, maybe the angels, the high net worth individuals, family offices who are trending institutional, but just call them in this category for now. That's the other source. And they are super interesting because it's going to be really a personal relationship with the founder or a bet on the founder, typically. They understand the business, they made a lot of money in it, or they understand the problem, they made a lot of money in it, and they want to have some exposure to it. So they're the three sources of capital. And, aside from like bank debt, if you are a profitable company, you should, number one, consider debt first, I think. And private debt is actually becoming a huge thing.
Is that because you're just retaining all the equity, you stay in control?
Yeah, you don't have to sell any of your company. But if
or your soul.
And your soul. Well, I mean, no. Have you seen the underwriting from the bank?
Yeah, that's true. That's true.
Your soul is collateral. Don't worry about that. Yeah, but if you have a business that can survive that underwriting process and get some sort of credit, but the biggest booming area in capital markets right now is private credit. So it's super interesting and normally applies to later stage companies, but I don't think I would ever overlook that. I think it's really interesting, really good source of capital.
So what would be the dollar ratio on that? Like you'd have to be earning X amount of EBITDA or profit margin.
Yeah, you have to prove you can pay the loan back.
So you need some history. You need a solid P&L,
and you've got to have collateral, right? So the collateral is either going to be your accounts receivable, physical assets in the business, IP, whatever. I mean, there's different levels of underwriting, and that will depend on the interest rate you pay.
I guess it's good, right? Like they're not calling you every week going, well, where's our money? Because if you don't pay it, they basically just send you a demand.
They'll find you. Don't worry about that. Yeah. But so that's not an option for most companies because they don't have the cash flow. They're not credit worthy. They don't have the history. So then it's a matter of, okay, well, out of those three, what makes most sense? And in the early stage, it's going to be the private guys because the institutional guys, especially if they've got a bigger fund, $50, $100 million fund, they can't be writing 200K checks. It's not worth their time, or even $1 million check, right? So the first thing is when you speak to an investor is what's your check size? So you just can filter out, okay, well, minimum we invest is in 5 million. And we need to see this much growth, this much revenue, this much other traction.
Yeah, interesting. Okay, so I'm going to talk about Visera.
Oh, yeah.
Right, let's get into that.
Yeah.
So full caveat, Mark's Chief Strategy Officer for that startup. It is a startup. It's only probably 6 months old. as we try and navigate an AI startup company in Australia, right?
Yep.
So we've gone through a little bit of a process. So I've learned a lot during that time, and we're sort of at the point where let's get an investor list together and go for it, right? Do some pitches and see what happens. So I find it super interesting though, because like my mind was like, okay, I think we should go niche, right? So we have an existing company, it turns out millions of dollars in revenue, it's clean, it's debt free, and your take was, without the pedigree, like I didn't go to Harvard or Stanford, right? But so without the pedigree, is having that existing company and leveraging that a valuable or viable option to go and raise funds?
Yeah, absolutely. Because number one, right, you're solving your own problem, and you are immersed in the market. You're very deep in the RTO industry.
Yeah.
Right, that's key, right? So you're very credible. If you'd never done an RTO business before and you just said, hey, I'm going to solve this problem, it doesn't really ring true with investors. Yep. So there is actually a strong pedigree there of actually running the business for almost 10 years, getting to 8-figure revenue. 8 figures in revenue. So yeah, that is like, they love that.
Yep.
The reason why we want to maybe treat Vocera separately but kind of equal to the rest of it is because the other businesses, taught us the learnings and understood the industry and showed us where the problems were. But the things that, created the problems and are the problems aren't going to be the ones to solve it. So we need a new set of tools and a new kind of essentially business to be able to solve the problems that we want to solve, because we don't just want to solve it for your group, we want to solve it for the whole industry. Yeah. And the best way to do that is to have its own kind of house.
It was super interesting going through, looking at the market cap, how many people on the market, what's the market worth, right? Like that was such a valuable exercise to do, and I learned a lot from that exercise. So the advice for startup founders moving in that space is sometimes they start a company and they don't even do that. You know what I mean? So, what percentage of the market can you tangibly or realistically take?
Yep.
And how big is that?
Yep.
Right. And then what's that worth?
Yeah.
So can you talk a little bit about that application of it?
Yeah, absolutely.
The market,
it's like going to be the first or second question an investor asks you once you've done your pitch, if you don't cover it up front. But like, is this a business worth being in? Like, is this a large and growing business, right? Yep. So education in general, huge market. I mean, we spoke about education at the start, but one way or another, education is going to be here forever, and people are going to need skills. They're going to need more skills than they need education. They're going to need to know how to do stuff.
Was it 14 billion?
Yeah, it was incredible. Yeah,
so it's big.
Yeah, so a couple of $1 billion a month are being spent in this country on this stuff. So it's a big business, and it's growing, and it's solving a real need. Like, people need education, people need these skills, especially in the area we're in, because like we have labour shortages. We've got a large event in 2032 here. Hopefully, we're ready for it. But so that's critical. Now, what percentage can I realistically capture of that? Like, so I want to start a business where we're early, so we want to dominate eventually. But the first couple of years, even if I'm getting 1 or 2% of that market, that's going to be meaningful.
Yeah.
And if I can get to 1% or 2%, I should be able to get to 5 or 10. If I can get to 10, I can get to 20. When you start to be successful, it attracts competitors. Obviously, that's how capitalism works. If they see Vocera being really successful, other people come in, people will pivot and try and take some of that market share off us. But, if you're there first, and people, you can get embedded with these companies. So I think a lot of the exciting thing about this market, if you get embedded with an RTO, it's unlikely that they're going to change technology providers like at all. Like, you could be there for years. So lifetime value is going to be very long, I think.
I watched I can't remember the CEO of and founder of Palantir, right? And it was a great interview. He's a kooky guy.
He is.
He looks like a kooky guy.
Yep.
But they're part of their business model was to create systemic contractual arrangements with their clients, and from a client perspective. So it's not a SaaS platform. You don't subscribe to it. They embed the client in the business. He seemed very focused on ensuring and securing revenue. And if they were going for government contracts, the one way we do it is you don't have a full SaaS subscription style business. Is that we want to embed clients on their servers.
Yep.
Which I found super interesting.
Yeah.
Right? So there's always that thing, and especially with AI, where everyone's moving towards that subscription model. And we're in the education sector.
Yep.
And I remember going through that process and thinking, okay, well, how do we become sustainable? Because you can build a product, you can sell it to a company, and they can purchase it from you. So, what's your take on that? Is it about? Do you have to be really preconceived about? I know when you go to product market fit and you're looking at, how is the customer going to benefit from this? Mm-hmm. But you said once you're in there, they won't leave. Mm-hmm. But is that actually the case? Like, how do you secure that client, that business?
Yeah, it's interesting, and they might not leave. But start with Palantir. I think that it's when you see successful companies, it's dangerous to try and draw a conclusion that could be useful. So I think as a case study, Palantir is fantastic. Can that ever be repeated in another industry? Like the stuff they do, the secret stuff they do for governments and stuff, it's like a really, really kind of outlying kind of business, and it's crazy. And even half the people that work there don't know what it does. I remember their office used to be like right in the center of Palo Alto, and we'd walk past it, and you couldn't see in the windows or anything. It looks super kind of secure, and it's a fantastic business, but probably like a once in a generation kind of unique outlying business. Run by a really unique person and Peter Thiel as one of the core investors and stuff. So really hard to replicate set of circumstances. And how they do things could be interesting, could be lessons to be learned. A lot of the time it's just like, well, you're the expert on education, vocational education and training in Australia. No one knows that better than us. So the way we go about things will be uniquely our own way, because we understand the customers the best. And, we know how, yes, we can get in there. They have a low propensity to want to switch because, we're doing the good job for them. But, once we're in there, we're going to make sure that we never leave by getting all the data and like coming up with our own playbooks and so forth. And I think that's
just delivering an epic product, right?
That's it. Like, it's just, I love it. But like the best product is actually don't have to think about it. It just, and we get the invoice every month and we just pay it on auto payment because we don't have to, because the results are there. It's like solving a headache for me. I used to have to do this. It was costing me hours and time and money. And that's all gone. It's just very smooth. It's improvement. I can see it working. That's really hard. If you've got to explain to people, if you do a trial with someone or you're coming up to an annual renewal with a customer and you've got to sit down and explain the impact it made on their business, you've kind of lost already.
Yeah, you're right. Don't go chasing unicorns, right? So I think with the Palantir, when I heard them embed clients into government, that's probably a security thing. So
of course it is.
It's got nothing to do.
Yeah, I mean it's all Pentagon and DOD and all sorts of crazy stuff. But look, there are other probably other examples, but we can draw from the best in class in each industry, and also because we're the experts in this particular niche, then we should be able to do our own thing as well.
So, market cap figured it out. This is how big it is: $14 billion a year. We've figured out what we think we can acquire from that. We've looked at the players that are in the market. There are no players in the market, so we're going to go for it, right? So we're going to raise probably 3 to 5 on that first series. Invest that into build, right? Staff, engineers, that type of thing. So then we get to the, obviously there's business planning and there's all this documentation and discussions that you have to have over a period of time, which we've done. And now we're getting to pitch, right? Which is scaring the shit out of me just a little bit. But I'm super confident in it. Why? Because I believe in the product. I believe that this can add value and really contribute to people's businesses, lift efficiencies and save money, right? So it's great. So what's the, I saw the Sequoia strategy for fundraising. Right? So can you just maybe talk lightly about, maybe not specifically Sequoia, but in general, the steps in the application of applying yourself to fundraise for a startup business? Yeah,
exactly. And again, it depends on the phase, because like a seed pitch looks very different to a Series B pitch.
So what's the difference between a seed and a Series B?
A Series B, you're going to be talking about your traction and results that have happened. Because you're trading, and if a company, so the life cycle of funding is like, okay, bootstrapping or just getting the idea together. Seed, at a seed stage, you have maybe an MVP product, you have maybe some trial customers, you don't have a lot of metrics, but you do have like committed founding team, like convincing CEO, a credible story, a large total addressable market, a serviceable market that you think you can get, and it all looks pretty good.
Yeah.
By the time you get to Series A, it's all about, okay, well, these things have happened. What you told me in the seed round should have come true, or something else has come true that's equally good.
Yeah.
There's traction and revenue.
Yeah.
And so that's kind of a post product market fit. A Series B is a growth round. Like, things are humming. We're at PMF for sure.
Yeah.
What Series B will do is give us capital to basically invest in sales and marketing and outreach. Like, the product's good.
Yeah.
There's three types of risk, right, in a startup.
So in that Series A, I know you probably in your seed you've got product market fit.
Well, not necessarily. I mean, you're going to, like, there's the three risks that you're trying to look for, like product risk, market risk, and execution risk.
Yeah.
So in a seed, you've probably got all those three. So there's, okay, well, it's new. There's product risk. Okay, they've built the product. The market risk, that's probably the easiest. Hey, this is a big market. This is a problem.
Yep.
People are spending money on this. So we don't have to teach people to spend money on this problem because they're already doing it. They're solving it, but just in an inefficient way. Vocera comes in and does that automatically. So that's a good story. And then execution risk. Like, Series B is more about execution risk. Okay, things are humming along. Can this CEO scale up? Can the company scale up to be a $50, $100 million business? So that's kind of the different levels of risk. But in the early stage, it's all about just convincing people that you as a founder have a good vision and can execute it.
Yeah. As you're going through seed, Series A, Series B, and you're adding people to the team, like you might need to give away equity. Talk to me about dilution. Like, how does that work?
So there's going to be dilution when you take external capital for the first time. Obviously, there'll be a certain amount of the business that you are selling. You're issuing new equity typically and selling it to the investor. As part of that round, they might say, well, you should create an employee pool as well. So employees
can... a different style of share for employees?
Well, so it just depends on the investors. So typically the founders and the employees are going to have common stock.
Yeah.
The investors, depending on the sort of deal you do, might have some sort of preferred stock, which might have like a preferred return built in, which you got to watch for that. It might have different voting rights, information rights, and obviously, so you want to avoid. And in the US, you've seen founders give themselves like a super class of shares, which has 10 votes for every share they have, and it's impossible to remove them from the business. So
work.
Well, other businesses like that for sure. But it's, you need to, ideally everyone has common stock and you're on the same boat. But, the VC comes in, they've got a 2 times liquidation preference, which means, they're getting 2 times their money back before anyone else gets $1.
So, and I get the pitch. And you've got the list, you've got your pitch ready. Like, how do you get them in the door? How do you get their time? Like, that's do you set up nurturing funnels? Like, how does that work?
Yeah, it's like any kind of enterprise sale, right? So you get a list, you get a pipeline of customers, you do cold outreach, you try and get introduced through your network, you go to events. You generate publicity and send it to them. So you do press releases, you get coverage, you try and create a bit of heat, a bit of buzz.
You've got to do everything like you would in a standard business to sell your
exactly.
product.
Yeah, you've got a new product now, which is my stock in the company, which I'm selling. And that's in addition. So it's exactly the same. And even when people who aren't necessarily ready to invest, you're still sending them a monthly update or quarterly update. Hey, these are our wins. We've just got these customers. We've just released a new product. So you're always, because they might not want to invest at seed, but they definitely want to have a look at you at A.
Yeah.
So you just keep those relationships warm because it is, they're investing in people. So it is a lot of time, but you do have to go out, shake a lot of hands, go to the networking events in Brisbane, Sydney, Melbourne, wherever, and meet people and do your pitch. There's no substitute for pitching. It's like running a marathon. You just got to run.
So for a young founder, what do you have to watch out for, right? Because I think, there's got to be some sharks out
Who's
there,
this young founder you keep talking about? It's only us in the room here.
But, there are lots of these young kids and they watch the show. They tap into this to try and get advice and learnings. But, if they're thinking about that, are there sharks out there? They're going to take advantage of you. What are some things
absolutely
they can do? And
that's what I mentioned before. Like, investors will put particularly egregious terms in front of you, like 2 or 3 times liquidation preferences and like a preferred interest rate and all sorts of things that maybe tie your hands, or you end up with a $20 million exit and you end up with $50,000, right? Because of the waterfall.
Yeah, you don't want that.
You don't want that. So, like anything, of course. So, it really does pay. And I think again, the resources available now, if you're serious, and if you're starting a tech company especially, you're a smart person, so you can go and do the research on this structuring your capital cap table and how that all works and how different distributions work and the VC business model and what's important to them. Because no matter what it is, their job is to invest someone else's money because they're under pressure too, right? So they're fundraising. People forget that VCs are constantly fundraising.
Yeah.
They're constantly going out to LPs trying to raise money for the next fund. The only way to raise money for the next fund is to have good performance in their current fund. So these are our distributions, these are our hits. They love that kind of stuff. So then they can get some of the Australian super money or Hester or what are these big institutional family office done, manage that. So they know all about fundraising because they're doing it nonstop. So research the fund, like what is interesting to them. Where are they at with the fund? It might be a 10-year fund, but if it's at year 8, they've probably stopped investing. So in a 10-year fund, you're probably only investing in the first 3-4 years to distribute most of the capital. Then they keep some for follow-on rounds because if you're there at the Series A, I want to maintain my ownership level, so I'm going to have to participate in Series B or I'll get diluted. So for their hits, they reserve money to double down.
Is that how it normally works? You would be diluted through that process, or could you have shares that are fixed and you would not be?
No, you'd be diluted. And it's an interesting signal, right? So if your Series A investors don't invest in the Series B, people are going to ask why. That doesn't make sense. So make sense. So, that's the first thing. Okay, are the initial investors coming along to maintain their pro rata?
Yeah.
Because if they're not, it's like, well, what do you know that I don't? You've been in this company for 3 years. Why aren't you investing again? I thought it's like, look at these numbers. These look exciting. So there's all the sort of signaling risk if that doesn't happen. And there's, I'm sure, reasons why people wouldn't. Maybe they just can't, or I don't know. But normally, if you think you're on a winner, you're going to double down and you would have reserved capital because when they're making that Series A investment, they would have modelled making a Series B at least. Yeah. Sometimes, they get to a point where they have to tap out because they don't have to make. Because if you do a Series C and it's like $100 million, you might say, hey, we're out. But that's cool. They'll take the dilution at that point because the company must be doing spectacularly well.
So cap table, so everything you have to put together to go to the market, to raise funds, what do you need? Outside of a pitch deck, so we've spoken about that a bit. So what do you need to put together? Yeah,
so the story has to be tight. You need to have a data room. These days it's called a VDR, virtual data room, and that has all the things that an investor might want to see to do their due diligence, which is the zero outputs like the P&L, the customer contracts, the staff contracts, the insurance, the bios of the team, like all the things that are documented about your company, because they will have a checklist, a due diligence checklist, and whether it's important or not, okay, they've got the right insurance, they're up to date on their super, all these sort of hygiene factors. Okay, let's drill into the customer contracts. So they have this contract with customer X, that's interesting. Customer Y, looking at the payment. So all that sort of stuff, they will really want to look under the hood. And in a seed stage, there's normally not a lot there. It's a pretty brief process.
Not a lot at all. Not for us. It's a brand new company. Right?
Exactly, right? So, but for a more mature company, they want to really look into, but they'll still look, where's your financial model for the next 3 years? How do you think, now it might not come true, but how are you thinking about it? What are the levers that drive this growth, drive this margin? Do you think you're going to be profitable in 3 years? Where are you going to need money next? Because it's like,
so forecasting.
So the Series A or the seed will get you to a certain point. An investor will ask, where does this get me? What does the revenue look like? How big is the company? And then how much will you need then?
So can I ask, will any potential investor look over here at this P&L if the founder has an existing business generating revenue? Is that normally part of the sort of due diligence?
Well, I mean, only to prove that you can run a business. It doesn't materially affect that because they're not investing in this business. But I think you could say, look, I mean, the proof's in the pudding. This company's been around for years and we're doing all this and that's how we know. But they're investing in like this new asset, which doesn't have a history, and they're trying to get ownership in that. Well, you've still got ownership in your tech skill business.
So you need an investor list. You need to identify who your investor is, and you need to be ready to go out and pitch to close the deal.
And you just have everything ready to go. You need, like, the pitch deck should have different edits. So should there be like a teaser deck for maybe the outreach email, like of 1 or 2 slides, 3 slides. There's the in the room deck, which is maybe have 10 slides to talk to someone depending on the situation. There could be like the post-meeting email deck, which actually has 30 slides and more detailed appendices and breakdowns of stuff. So there's all these different, and that's why I said start with the 30-page one and cut back from there.
So So you put together a pitch deck for me, and I'm playing around with that pitch deck, and I'm creating what I call a long form pitch deck. Right?
Yep.
So it's about a 20-minute pitch.
Yep.
But I want to get everything in there, and then from that I can break it down into a 10-minute one and then a 3-minute.
Should be a 2-minute one, yeah. Like the genuine elevator pitch, because if you meet a VC at a networking event or investor, or you're just having a quick phone call, it's like this is what we're doing.
Yep.
This is why you want to get them intrigued enough to hey, let's talk next week. Let's have dinner, whatever.
As I'm writing the deck, I'm thinking about the questions they're going to ask me, like. So, and I know they're going to get to the point. They're very agnostic. They don't care about anything else. I need the facts. So I'm actually relatively confident about that. But what's sort of preparation for first timers like me? Like you got to know your stuff. You got to know the story. You got to know what problem you're trying to solve. I get that. Like that's all critical stuff. But I would think that weighs quite heavily on their decisions, right?
It does
come down to the founder.
They will ask, they'll ask the why you, why now, who are your competitors? And you might say no. They say, well, I don't believe you. I mean, obviously, every enterprise product has a competitor that's doing nothing. Like Inertia is the biggest competitor you have, right? So we're just like email, right? We like inter-office envelopes. We'll keep that. Thanks very much.
Yeah.
But I
will never get rid of my BlackBerry.
Yeah,
ever.
yeah, exactly. That's right. But now, so they're going to ask the questions, but it's like, why is this a big market? Like, is this? Yeah, I've seen your term. Is this really a big enough market that we can get? Can you become $100 million business?
Yeah.
Or even a $50 million business.
So do they want to essentially 2 or 10x their money?
Well, the early stage people, yes, obviously they'd love to 5 to 10x if they're coming in that early because there's so much risk.
Yeah.
So if I'm pricing the risk in an unproven company with limited revenue versus the return I'd want at Series B or C, well, it's proven. I expect much lesser return, but I've got much less risk as well.
Yeah, it's interesting, right? I think you're right. It's the temperament and the timing of the business.
Yeah.
Which delivers the sort of risk ratio.
Yep.
Which say, hey, well, if I'm only going to 2x my business, what's the point?
Yep.
I'll just go somewhere else.
Yeah.
That's really important to know.
Yeah.
Yeah. Well, we are just about there. I would think we'd be pitching Visera to the market for our first investor next month.
Absolutely, yeah.
On average, from your experience, how long does it take to? I know it's like how long's a piece of string, but I remember seeing the guys on Founders Table, and I think they got to the third pitch. Oh, maybe it was the fourth pitch. Fourth. It was the fourth pitch, and they secured a investor. It was only a $1 million. And it wasn't really an investor. It was someone who just says, "Look, I like you guys. I want to be involved.
Yep.
We still need to go raise money, but I'm going to put $1 million up to assist in that journey."
Yep.
Which is weird, right? But that actually happened. So they were on pitch 4 and someone said, hey, I really like you. He didn't say a lot about the product. I'm not too sold on the product, but he liked the 2 founders because they'd exited for $180 million in their first company they bootstrapped.
Yep.
So the question is, in a roundabout sort of fashion, how long does it take?
Yeah, and that's a good point. So there's not a lot to say about a product in these early companies, right? It is about the founders. And if you do develop those personal relationships, because you're going to get a deal much faster from people who know you and are betting on you rather than the company.
Oh, God, I hope people like me.
So, well, I know. You never know, right? But there's, so when and it comes down to being targeted and thoughtful about your investors. So if you're investing in someone who's never invested or pitching someone who's never invested in education, doesn't understand the sector, doesn't really understand what you're trying to do, then you're probably wasting your time. So the person who is more likely to invest has thought about this sector for a long time, understands the problem. You're not telling them, maybe you're telling them something new, but it really makes sense to them at the first meeting.
Yeah.
And obviously they know your track record.
Yeah.
So if you're super targeted, so if you just spray and pray and just do 100 pitches, it's probably not going to be that effective because if you're dealing with people who don't know vet, RTO, the problems that we're solving with this product, it's going to be a much harder slog. And they'll say, oh, that's cool, I love it. Come back when you've done this. Because it's never no, it's always just not now. Investors never want to close the door permanently. They want to say, oh, that's cool. We'll just come back when you've done this, this, and this.
It's funny for the guys. Every single investor says, hey, it's just not the right time for us.
Like if you come back in like 6 months when you've You've done this when you've got 3 more customers. Then you get
Yeah.
there and it's like, well, come back when you've got 10 more customers and the revenue's this. So no one ever says no.
Yeah.
They just say not now.
Yeah. So it's interesting what you said though. So investors can be quite niche, right? They want to stay in their lane, probably because it's security for them, right? Like they know the market, they know what's going to happen. They can help the founders because they're experienced.
Investing is a hard thing to do, right?
Yeah.
So even the best VCs in the world are not getting hits every time.
Yeah.
Like the better ones are getting more hits in their portfolio, but it is a hard thing to do to identify and see potential in an early stage company that is really just getting going.
Yeah.
Like that's a rare skill to have.
Yeah.
You're more likely to be successful at that if you really know
Yeah.
the industry and the market and so forth.
Yeah.
So that's, absolutely. Yeah. So it's like anything, like,
Yeah.
we're really focused on our sector and we're not expanding to others. We might in the future, but we're really narrow on this because this is what we know.
Well, I'm super pumped. It's good to know you, and I'm so thankful that you're helping out with Basira and this new startup because it's super exciting, and I'm really looking forward to meeting with some investors next month. I think I'm just going to hide under a blanket. It's all going to work out and be fine.
That's going to be amazing. You'll love it.
Look, I'm pretty confident though. I think, in a market when the founder knows the market so intimately and so well, I'm hoping that sort of gets us across the line. But appreciate your time today. Really good to chat to you.
Thanks, Lawrence. This has been fun. Thank you. Cheers.